My name is Brian McKenna, head of investor relations for Ridgepost Capital. Great to be here today. We have Luke Sarsfield, chairman and CEO of Ridgepost Capital, Rob Ladd, managing partner of Stellus Capital Management. Maybe just to give a little context here, Ridgepost announced the acquisition of Stellus Capital Management back in February to further enhance and go deeper in private credit. And so that deal recently closed. And so I think it would just be helpful before we kick things off, just to hear both of your backgrounds. You have an impressive tenure. You've covered a lot of ground. So Luke and Rob, just to give a little bit of background, and then also too, just a little bit of an overview of the companies, the historical perspective, some of the main strategies, and then kind of where we go.
Well, thanks, Brian. It's great to be here with Rob, and it's great to be here with you, and really appreciate the opportunity to talk about the exciting Ridgepost Capital story, but also to talk about this really, really exciting combination and this partnership that we've now embarked on together. So as mentioned, my name is Luke Sarsfield. I'm the chairman and CEO of Ridgepost Capital. Ridgepost Capital is a private market solution provider working with our clients across private equity, private credit, and venture capital. We run about $49 billion of assets under management, and our focus is to really help our clients access specialized niche opportunities with a particular bent to the middle and lower middle market. That focus on the middle and lower middle market is really defining of who we are, defining of what we do, and it's a real benefit, and it's part of the strategy of coming together with our colleagues. And so we're really excited about the opportunities that we can do together, and that's kind of emblematic of what we've sought to accomplish on the Ridgepost Capital platform and what we're going to focus on in the future.
Yeah, thank you for being here with us, Brian, today, and it's great for us to be now part of the Ridgepost Capital team. So my background, I'm the managing partner of Stellus Capital Management, also serve as chairman and chief executive officer of Stellus Capital Investment Corporation. I have about 25 years of private capital investing experience and have led companies for about 40 years, so long history of investing and managing. As background, Stellus was started in 2012, and we're based in Houston, Texas. As you know, we're focused on senior secured lending to lower middle market companies in the United States, backed by private equity firms. So our investment team, senior team, has been investing in private credit for over 25 years together, and along his track record that would comprise $10 billion of investing across 375 companies.
Let's just talk about how the transaction came together. I think I met both of you roughly about a year ago, and so I think coincidentally, that's kind of maybe when all this started to come together. So I'm always like non-bank M&A. I'm always curious how those transactions came together. So maybe just talk about that process a little bit. Why Stellus, why Ridgepost, and really just some of the behind the scenes on what actually took place.
Well, look, I'm happy to start, and obviously really happy to be here with Rob today. But to your point, this is a culmination of a long dialogue around getting to know each other, around assessing and understanding the strategic fit, the merits of coming together, and obviously really thinking deeply about the opportunity set as to what we can accomplish collectively. And suffice to say, we're incredibly excited about all those things. First, I'd start with, from an M&A perspective, we always look first and foremost for great investing organizations. And that's the first thing we found with Rob and the team from Stellus. They just have an outstanding investment track record. They have generated consistent and persistent alpha on behalf of clients for a long time across different market environments, across different economic cycles. And that's really foundational to what we do. We want to be able to execute in a world-class way on behalf of our clients. The second thing we think about is the strategic merits of a potential combination. And I know we'll spend a lot of time talking about this, but this was really important to us. Obviously, we share a unique focus, both of us, in the middle and lower middle market. That's super important. In occupying that ecosystem together, we spent a lot of time understanding what we thought the opportunity was. And we're here to tell you, we think that the opportunity is quite meaningful to work together, leveraging the ecosystem set of relationships that we have across that middle and lower middle market sponsor community, and really be able to accelerate the sourcing opportunity, really be able to create more opportunities for Stellus to, sort of avail themselves and look at an even broader range of compelling transaction opportunities than they already are. And then the third point, and maybe the most important point, is culture. Obviously, there needs to be a strong cultural fit. There needs to be a strong affiliation. We need to feel like we're all going to do this together. And we're super excited with what Rob and team have built. We're very happy to announce that Rob and team are going to continue to run their investment process and continue to execute in the way that they always have and deliver for their clients in a world-class way. And now they're going to do it with the full strength and heft of the Ridgepost Capital ecosystem behind them. And we think that combination is just incredibly compelling. And also, we're really, really enjoying getting to know them. We've enjoyed getting to know them through this, through the M&A process, and we're really excited about what we can accomplish together.
As we spoke to Luke and management at Ridgepost, we felt that Stellus was perfectly built to be part of Ridgepost Capital. So for us, we were looking for a partner that could help us continue to grow our platform, and we found that in Ridgepost. But what we also found is something unique, which is the ability to increase our investment opportunities tremendously. This principally will come from the RCP Advisors business as well as the Bonaccord platform. I'd say the other thing culturally is Luke said from our perspective, Luke and his senior leadership team to us, we have great respect for them. I'd say they're focused on excellence, they're focused on outcomes, and they're team-oriented. And then finally, I'd say, as Luke has indicated, that we'll continue to run the investment process at Stellus, but benefiting from the operational efficiencies and really the global reach in terms of capital raising.
Yeah. Thinking about kind of the synergies, near term, longer term. And I think a lot of questions, I've gotten over the years, it's like you see these acquisitions, non-bank M&A, like how does 1 + 1 equal something greater than 2 or 3 or 4? And so I guess maybe talk about some of the opportunities there, and really as Stellus comes on board here and they get integrated, like what that process looks like. So they're kind of fully embracing just the Ridgepost platform, the network and all of that, and really just kind of what that all looks like.
Great question, and obviously really important in terms of how we thought about the potential for this combination. So as Rob mentioned, I think there are 2 main areas where we see a lot of value, and we think that value is going to flow both ways. But we think through some of our network of relationships, particularly around the private equity businesses, the existing private equity businesses that we have at Ridgepost, we can really help drive incremental value and incremental sourcing opportunities. Obviously through RCP, through Bonaccord, through Qualitas in Europe, we have a broad-based footprint across the middle and lower middle market GP sponsor ecosystem. And that matches very well with Stellus's kind of area of strategic focus, the ecosystem that they play in. When we look at the overlap in terms of the types of sponsors that we're engaging with and the type of sponsors that they're engaging with, they're literally fit kind of hand in glove. The overlap is incredible. And obviously, given our position, whether it's as a GP stake owner, whether it's as an investor in a large LP in those funds, I think we have the ability to really work with those GPs and help them see the benefit of, the full spectrum of offerings that we can provide within the Ridgepost family. And that will be Stellus being able to provide that middle market direct lending, that private credit look for them is going to be a huge part of that value add. But from a Stellus perspective, one of the things we hope and expect we can do is really increase the top of the funnel and create a lot more sourcing opportunities. They already have a great team doing that. They've already been able to identify the best of the best investment opportunities. But if we can create more shots on goal, hopefully we can score more times.
Yeah.
And then the next thing, and Rob mentioned, I think is the opportunity to leverage our global set of client relationships, our global distribution network, our capital formation team. They've obviously had a lot of success at fundraising across the Ridgepost Capital family. We've had an enormous amount of success in fundraising. One of the things we focus a lot on is our ability to leverage that LP base that we have of over 5,000 LPs and be able to engage with those LPs in a broader and deeper way across product sets, across solutions, across SMAs, and just bring the full richness and investing capability of the firm on behalf of those LPs. And having, just a world-class middle market direct lending platform is really going to augment our ability to do that. And I think it's going to accrue to everyone's benefit on the Ridgepost platform.
And then I guess on like the LP side, Rob, just some of your institutional clients and LPs in your funds, like, I guess one, how much overlap is there with the rest of the Ridgepost team? But like, how has their reception been so far, just as you kind of get to this next chapter and this next kind of pivoting point for Stellus and kind of your platform?
Sure, Brian, great question. We've had incredible receptivity from our investor base. Very excited. They know the Ridgepost Capital platform. Most of them do, I would say. We're learning too, as we've gone through the process of getting their approvals, that they already are invested in different vehicles have been cited. So we think tremendous opportunity, well received by all of our investors.
Yeah. You've talked about this quite a bit over the last several weeks and months, Luke, but yeah, I think you really are a holistic capital solutions provider now to the private equity and the private markets. And I think the Stellus acquisition brings in another kind of added capability on the credit side. And so you're an LP in a lot of these private equity funds. You can provide the debt capital and the leverage for those deals, NAV lending, GP stakes, et cetera, et cetera, et cetera. So was this kind of the last kind of added capability or enhancement to kind of fully offer that kind of solution to these GPs? Like, I just want to think through or walk through how you're thinking about this and that dynamic, and then kind of the evolution of what you can do ultimately with sponsors longer term.
So at Ridgepost, one of the things we're really excited about is the market opportunity in front of us and how we access that market opportunity. The middle and lower middle market, sometimes we get questions about what is the size of that it's a multi-trillion-dollar opportunity set. But within that multi-trillion-dollar opportunity set, there are a lot of very attractive areas where we can extract alpha, we can generate proper risk-adjusted returns. And we always approach it that the riches are really in those niches. We want to get after that opportunity, and we want to deliver that on behalf of our LPs. And this is part of the strategic vision that we have and we're trying to bring to bear. Ultimately, we want to be the category killer solution provider in the middle and lower middle market. That is the aspiration. And so I wouldn't say that this is the last, but I would say it's an important component of what we're focused on. And so when we started this journey a couple of years ago, now 2.5 years ago, we talked about at our investor day, there were 3 areas of strategic import based on LP feedback, based on looking at where the opportunity set was, that we thought would be incredibly additive to the Ridgepost Capital platform. The first was international strategies and as I like to call them, international analogs of our US businesses. And obviously the Qualitas deal that we did last year was a big component of that. They're essentially the international analog for RCP advisors. And we still think there's a lot of white space internationally across Western Europe, across Asia. The second was we really wanted to go deeper because of our centrality in this GP sponsor ecosystem. We wanted to go deeper and leverage those relationships in private credit. And so we have some great private credit businesses, but we also had some real gaps in our skill set and capability set. Direct lending was at the very top of that list. I also think about things like asset-based lending. I think about things like distressed and opportunistic credit. And then the third area we identified is the real asset opportunity, whether that's real estate or infrastructure. But I think the reason we're so excited about the Stellus transaction is because when you think about all those opportunity sets, it was so obvious that there was a big opportunity in the middle market in direct lending. And so we had the opportunity to really partner with the world-class platform in doing that. And we think the combination of our network of relationships, our skill set, and their obviously incredible investing acumen, when you put that together, that's a winning combination.
Got it. Shifting gears a little bit here, I do want to talk about private credit. It's been a great buzzword the last 6 months to a year, but there's so many different buckets within that, right? You have asset-based lending and then direct lending, and obviously, Rob, you and your team are focused on the direct lending part. But let's just talk about the industry, what you're seeing just from some of the trends and the flows. Obviously, focused more on the lower middle market versus the upper middle market, and so I would love to just get a little bit of your perspective on kind of current affairs and state of the union for private credit, direct lending, and really what's happening in the lower middle markets.
I'd say a great environment to continue to lend. We see a lot of opportunity for private credit generally, but especially in our market, the lower middle market. Interestingly, the best data we have would tell you that there's roughly 10 times the amount of dry powder in lower middle market private equity firms as there is in lower middle market private credit. So we're very busy, continue busy. In fact, we've been busy for 10 plus years, so continue to be busy. And we focus certainly on underwriting, which we'll maybe talk about a little bit later, but very important in terms of our underwriting, have a long track record of doing that. But optimistic about where we are. A lot of noise, as you say, in the system, but I think it's starting to settle out as it should.
Yeah. And one of my observations has been too, it's kind of the perpetual versus the constrained strategies. I think Ridgepost and Stellus both have, for the most part, these constrained strategies where they're managing the capital. So maybe just talk about kind of the fund structures a little bit and really the differences between both of your businesses and some of these other perpetuals where there's daily, monthly, quarterly flows. It's based on NAV, and so I think it would just be helpful to get a little bit of perspective on both of those from you.
I think one of the benefits, to your point, that we have relative to many others, when you look at the vast majority of our assets, the vast majority of our assets are in long dated, committed, delayed draw vehicles. And there is no, when the investors sign on for those vehicles, they understand implicitly and explicitly, there is no consideration of liquidity in the short to medium term whatsoever. Obviously, we will get them a lot of liquidity at the end of that, but they know what they're signing up for. And there is no question, there is no confusion, there is no ambiguity about that. We do have a few products, a very small portion of our overall AUM that is obviously in some of these different types of vehicles, whether evergreens or otherwise. But I would say we have seen, and I know Rob's going to echo this, we have seen really, little to no, desire, request, motivation on the part of any of our clients to want to take capital away. In fact, I think most of our clients see the opportunity set. They actually see some of this disruption as creating opportunities to lean in and to really allocate more capital. And so we're seeing that. And then I think when you look at portfolio construction, a lot of this noise has happened at the upper part of the market. And it's, to Rob's point, it's much more commoditized. There is a lot more capital chasing many fewer opportunities. And so you understand that natural supply demand tension. In our part of the market, there's an incredibly rich opportunity set, and there is relatively a lot less capital against that opportunity set. And so I think if you're an allocator and you're saying, where's the highest and best use of my capital? If I want to, sort of get the best risk-adjusted return, I'm going to allocate in the middle and lower middle market.
Yeah, well said, Luke. So I'd say very similar for our platform. Of our close to $4 billion of assets under management, almost all of it's in permanent vehicles or commingled funds with long lives. So, and in our non-traded BDC, we've had modest redemption requests. So very stable base. In fact, our last fundraising effort was roughly $1 billion of equity capital combined.
Yeah, no, that's great. And I'm curious to get both of your guys' perspective, and I think it's maybe playing out real time, but your point around the opportunity in the lower middle market, I think there's not a lot of overlap with the upper middle market, and there's really more excess return. So Are you seeing any early indication or early dialogues with your LPs about how they're thinking about that allocation process? I think they probably put quite a bit into the upper middle markets, and there's a lot of overlap there. And so as they look to diversify away to create more, less correlation with other parts of the public market, private markets, and so talk about that, and then really how big of an opportunity is that as maybe we see this reallocation kind of coming through the private markets?
Yeah, I mean, look, it's a great question. And I think we are seeing that. We are seeing the client engagement around that. And I do think it's a really meaningful opportunity. I think if you rewind the clock a little bit and you think about sort of how we got to where we are and then where we go forward, the reality was many of these large allocators kind of, set their portfolio allocation methodology 80-20 or 75-25, with that allocation to the private markets. And then they looked how to deploy that. And generally their first move was large, some of these brand household name allocators that generally play in the upper part of the market. And I think what's become very clear to many of these allocators is that it wasn't by design, but it's kind of by coincidence. They had a lot of cross correlation, whether it was co-ownership of assets or, one of their large sponsors selling an asset to another one of their large sponsors, or one of their large credit providers providing debt to something that was owned by one of the large sponsors in their portfolio. They just found that they had a higher correlation than they thought they had. And so they're looking for places where they can get diversification, but also a superior risk-adjusted return. And I think they're increasingly seeing that that's in the middle and lower middle market. But the beauty at some level of the middle and lower middle market is it's much more opaque, it's much more complicated, it's much less easy to understand what's going on. There aren't the great data sources. You can't read about the deals in the Wall Street Journal all the time. You've really got to be embedded in it. You've really got to have data. That's another thing we pride ourselves on, is our data advantage and our ability to extract insight from that data and have that data make us better investors in many ways and leverage that data across the platform. And we have really compelling and profound data that allows us to do that. But when you put it all together, we can leverage that data on behalf of LPs, on behalf of allocators, to really help them build an integrated, risk-adjusted, appropriate to whatever their return profile is and their cash flow profile is, solution in the middle and lower middle market. And just one other point on the middle and lower middle market around why we think it's such a great place to be in. When you look at it on virtually every metric, we think it's superior to the upper part of the market. There's less capital chasing more opportunities. Generally, those opportunities are not as intermediated by advisors. Generally, you're buying portfolio companies that often come from a founder, right? And so the opportunity to lean in and really do value creation is very meaningful. And what's the net result of that? The net result of that is you're able to buy the companies generally at lower multiples of EBITDA. You're able to put less leverage on those companies. And so your ability to drive excess return is just higher, particularly if you're a world-class operator. And we're very lucky to have world-class investors and operators on our platform.
Got it. And then Rob, back to you, and maybe just going back to some of the industry questions. Credit quality, I think, is top of mind for a lot of people. And so there's probably a cohort in the market that thinks this big credit cycle is coming, but what are you seeing on the credit quality front? And just thinking about the macro that we're in today, how is that impacting things? Has the watch lists, have any of those kind of metrics changed at all? And then to Luke's point on decades worth of data and underwriting, I think it'd be helpful just to walk through your underwriting process a little bit and how you can leverage the different cycles you've seen in the past and all that data and the trends there to make better, more informed decisions moving forward.
Sure. So in terms of underwriting, again, always been a core part of our business. Maybe talk about it a little bit in different examples. So when we look at a new company, we've always looked at it, what if we have a recession in the next 18 to 24 months? And back test, if you will, if the company existed for recessions. If it didn't exist, did the sector exist for that last recession or two? And if the sector didn't exist, which is common today, we look for a proxy or an analog to look at it. So we're looking, underwriting is, can this company survive a recession, first of all? I'd say the second thing, very selective in our execution. So roughly 3% of what we look at over 20 years, if you will, we close. So highly selective. How are we able to do this? Tremendous deal flow, opportunities that come to us through our managing directors. Probably it'll be even more when we're part of Ridgepost, I would say. So it may go down to 1.5% in terms of selectivity, but hopefully all those will be hits and winners. I'd say the other thing is in the lower middle market, we really benefit from something that might be different in the upper market in that the capital structures are quite strong. So typically you're getting 50% or more equity checks below us at close. We have financial covenants in all of our deals. And as an example, in our most recent fund, Stellus Credit Fund 4, we have 41 new investments. The average equity check below us is over 60% of the capital, and the average EBITDA is about 3.5 times EBITDA level. So very strongly structured companies. In terms of the macro environment today, certainly there's a lot of things going on, including the war in Iran, which has elevated certain things like commodity prices, certainly in oil, but very limited, if any, impact on our portfolio. But anyways, solid position. Whether we can make mistakes or we work hard on them, but they're very rare. And all of our partners have restructuring experience, so it informs both our investing as well how we handle problems.
Yeah, I think the vast majority of our portfolio is private equity backed. So maybe just talk about the importance of having that sponsor backed borrower and kind of how that drives outperformance longer term.
Right. So great question. So we've been investing in private credit for, say, over 20 years in all categories. But over the last dozen years or so, we've been solely focused on private equity backed companies. And the reason for this is really twofold. One, you have a strong owner. They're smart. If the company gets into trouble, we found that typically a private equity firm will put in new money at least twice to solve problems. So smart investor, capital to put in. I say the other thing that's helpful in dealing with private equity firms is it's actionable. So when you're lending money just to a company, they might have not done a financing like this before. It might take months, they may not do it. But when a private equity calls us, we know it's going to happen, and sometimes it happens in 30 or 60 days. So that evolution occurred about a dozen years ago, proved to be very effective in terms of our loss rates, kind of delivery of deal structures, and a space we think, and by the way, we think a lot of white space left in it.
Let's talk about the future a little bit, maybe touch on the integration process from here. And if we kind of wake up 1, 2, 3 years plus down the line, what does this all look like? How are the teams coming together? And really, I guess, looking over the next year, like the top 3 priorities, just in terms of the integration and kind of extracting some of those synergies.
Yeah, I think it's a great question. Something we think a lot about. We've spent a lot of time on as we've come together in this great new partnership. I would say number one, and this is a really important point. I've mentioned it. Rob's mentioned it. The integrity of the investing process needs to remain sacrosanct. That's how we approach it. And so Rob and the team, who have been leading that investing with the whole team below them, they have a wonderful team at Stellus, will continue to solely and fully control that investing of the capital process. None of that will change. And so first and foremost, they've had incredible investment performance. Obviously, we at Ridgepost across all our strategies pride ourselves on delivering incredible investment performance for our clients. And so the first and most important thing we want is for Rob and team to continue to invest as they have in a world-class way. The next thing I think we want to focus on are the opportunities that I think we both collectively see to do more together. And obviously we've mentioned what we think is that big sourcing opportunity, leveraging the collective network, leveraging the collective kind of, middle market GP ecosystem that we have such a strong and leadership position in. And then obviously the LPs, right? We think there's a lot of opportunities to do more, to go more broad, to go more deep with existing LPs on both sides. And we're really excited about how we can do that and how we can structure that to create a win-win for our clients and for us. Then I think the opportunity for us is, given the leverage and scale of Ridgepost Capital, there's a lot of expertise, I think, that we can bring. They obviously have great expertise, but across areas like distribution, across areas like data and technology and cybersecurity, in areas like human resource management, compliance and controls, finance, accounting, and operations. We have great teams, scale teams of world-class professionals who've been doing this a long time. And we think that there's a great opportunity to partner together and really extract some leverage and sort of get our processes working in a way that really leverages the size and scale and throw weight that we have across the collective Ridgepost platform.
Anything else from you,
Once
Rob?
again, that Luke said it well. So I would just say that a lot of preparation came into the closing. Transition teams meeting weekly. We're in a great position now to immediately hit the road with, again, RCP, capital raising. We're very excited about it.
That's great. And maybe one final note for me. So just thinking about like the Ridgepost opportunity and some of the key opportunities that come to mind, I think first and foremost, it's the people and culture running the business day to day. 2, it's the FRE centric model. It's capital light, third party asset management. And the third, it's the constrained capital base and the structure of the strategies. And I think ultimately that creates the excess return and that drives the flywheel longer term. And I think from my point, just to reflect on, kind of the combination and where we go from here. So, just want to make that final note, but this was great. Appreciate walking through this.
Thanks, Rob, and thanks,
you.
Brian.
Sure thing.
Thank you, Luke. Thank you, Brian.